Hi everyone, welcome back to Saheb Academy. Today in this 12th video of cash flow statement chapter, we are going to solve our 14th problem. But the question is actually from ICAI study material, practical question number 12, New Light Limited. That's the name of the question. Now the main thing about this question is here we have got an inventory valuation adjustment. See here company decided to value the inventory at cost and all. Yeah, this is an important adjustment that you have to understand properly, and it's a full-fledged question. Everything is there in this question. So let's just first analyze this question and then we'll solve the working notes and then we'll see the solution. Okay, let's begin. Now see here, let's just quickly read this and analyze. The balance sheet of New Light Limited as at 31st March 2021 and 2020 are as follows. Okay, two balance sheets have been given to us of New Light Limited. First they are saying 31st March 2020 and then 31st March 2021. So this is our previous year and then current year, or we can say opening balance, closing balance. Yes. So see here, first we have share capital, note number 1. Let's just go to the note number 1. If we go to the note number 1, we find first we have equity share capital, opening balance 12 lakh, closing balance 16 lakh. So increase by how much? 4 lakh. Why it has increased? Most probably we have issued the shares. There are no adjustment, nothing. Directly we can assume shares have been issued. Where it will come? Financing activity. We will add, because if we issue, we are getting the money. Okay. Next we have C, preference share capital. What is happening to preference shares? See, from 4 lakh it has become 2 lakh 80. It has been reduced. Why it has been reduced? Most probably we have redeemed the preference shares, right? So where it will come? Financing activity we have to subtract because we are making the payment in redemption. Alright, so we'll make a ledger account of that. So right now we'll just star mark it. Is it clear? Because understand, the redemption can also happen at premium. So we have to see the whole picture. Is it clear? Okay, we'll see what the question says. Next we have C, reserves and surplus, note number 2. Yeah, note number 1 is over. So note number 2, reserves and surplus. General reserve we have first. What has happened to general reserve? From 6 lakh opening balance, it has become 7 lakh 60,000. General reserve has increased. If it is increasing means what? We have made a transfer to general reserve. Of how much? Of 1 lakh 60. Yeah, 760 minus 6 lakh is how much? 1 lakh 60. Right? So what we are going to do about this? If we are starting from retained earnings, retained profit, then we have to reverse this appropriation, isn't it? By adding it in the operating activity. Okay, fine. Understood. Next we have C, profit and loss account balance. Opening balance is 2,40,000, closing balance is 3,40,000. So with this, what do? We calculate what's the retained profit, profit after all adjustment, isn't it? If we don't have net profit before tax or net profit after tax, then we have no choice but to calculate retained profit and start our indirect method journey from there, isn't it? That's what we do. So how much is our retained profit? You will see it's really simple. We do closing minus opening. 3,40,000 minus 2,40,000, that's equal to 1 lakh. But actually it's not 1 lakh, okay? Because there is an inventory valuation adjustment, so it will impact over here. So we'll see that later. Fine. Okay, leave that for now. Then moving on, next what do we have? See, non-current liabilities, long-term borrowings, note number 3. So in long-term borrowings, we have, see, 9% debentures. See, they have said 9%, which means there is a hidden adjustment of interest. We have to calculate the interest, right? Yes, we'll do that. Interest on debenture. Expense we have to reverse in operating activity, and then we have to subtract the payment in the financing activity. Yeah, the interest. Okay, fine. Hidden interest adjustment is there. Then what about the balance? What's happening to the balance? See here, from 4 lakh debenture balance have become 2 lakh 80. It has decreased. Why the balance is decreasing? Most probably we have redeemed the debentures. If we redeem the debentures, where we take it? Financing activity we have to subtract because we are making the payment. Is it clear? Now the redemption can also happen at premium, isn't it? Yes. So we have to do the proper calculation regarding that. So that is why we will star mark it and we'll see what is there in the additional information and all. Okay, fine. Then see, next what do we have? Next we have, see, current liabilities, other current liabilities they are saying, note number 4. Let's just go to the note number 4, other current liabilities. See, first they have given us dividend payable. Now dividend payable, whenever it is given, you have to see whether we have opening balance, closing balance, what we have. So here we have only opening balance. What did I tell you? Whenever there is only opening balance, that means that is the dividend declared in the previous year. Now in the current year, it will definitely be paid. So this 1,20,000 is just directly paid. You don't have to create any ledger account also. Directly you have to understand this. Fine. So this is the dividend that has been paid. Is it clear? Simple. So where it will come? Dividend paid. Dividend paid will be subtracted in financing activity. You all know that. Okay. Next, what do we have after dividend payable? We have current liabilities. Yeah. You see, they have not given us separate current liabilities like trade payables and all. Yeah. They have grouped everything together. So that's not a problem. We will directly consider that in working capital changes. Yeah. That's what we do. So what's happening to current liabilities? From 4,80,000, it is becoming 5,20,000. It is increasing. It is increasing by how much? By 40,000. So if current liabilities increases, what happens to cash? Positive impact on cash. Cash also increases, right? So we will add this in the operating activity when we do the working capital changes. Fine. So other current liabilities over. Then next we have short-term provision for tax we have. There is no note, nothing. Directly they have given opening balance of provision for tax was 3,60,000, closing balance is 3,40,000. So for this we definitely have to open the ledger account. All right. Next we have non-current assets. Yeah, all liabilities and equity are over. Non-current assets, PPE, property, plant and equipment. See here note number 5. Let's just see this. Okay. If we see PPE note number 5, see here 32 lakh opening balance and 38 lakh closing balance. So what we are going to do about this? Of course, we'll have to definitely open a ledger account to see everything, what has happened. But let's just see. Next, they have given depreciation also. Yeah, of course, they will give depreciation. Now you have to understand one thing here. The question has not mentioned whether it's, they're following charge method or accumulated depreciation method. See here, understand the value of depreciation are so huge. So you have to understand here they have given you accumulated depreciation, even though they have not mentioned over there exactly. Okay. So we will open 3 accounts. Whenever we have such a situation, we open asset account, PPE account, accumulated depreciation account and asset disposal account also. Okay, we'll do that. All right. So that's PPE. Then next we have non-current investment. Now regarding non-current investment, there is an adjustment. So we'll, have to open a ledger account. Yeah. Right. 4 lakh and 3,20,000. Yeah. It is decreasing from 4 lakh. It has become 3,20,000. So we might have sold, but we have to see the whole picture with the adjustment. We'll open the ledger account of investments. Fine. Okay. Next we have current assets. Okay. Cash and cash equivalent, which is the last item. You all know that 10,000 opening balance, 10,000 closing balance. There has been no change in the cash and cash equivalents in net. Yeah. If there is no change, then what would be our answer? Our answer should be 0. Yeah. Our net cash and cash equivalent, the answer should be 0. Then only opening balance will be equal to the closing balance. Okay, we'll see the solution at last. You will understand. Then see other current assets they are saying. Other current assets means we will consider that in working capital changes. Isn't it? Yes. So what is happening? From 11,10,000, it is increasing to 11,50,000. It is increasing by how much? 40,000. If current asset increases, what happens to cash? Negative impact. Yeah, so we will subtract this 40,000. But will we actually subtract 40,000? No, because there is an inventory adjustment, so it will impact over here. Okay, we'll see that. Don't worry. Now see, these are the adjustments. See, the first adjustment is regarding PPE, second also PPE, third also PPE. So 3 adjustments are there just about the PPE. And then the fourth is regarding investment we have sold, and then debentures and preference share capital have been redeemed at 5% premium, and the debentures were redeemed at the year end. And then the last adjustment is regarding inventory. Okay, so now let's just prepare the working notes and we will completely understand each and everything. Now see here, we have the working notes. How to prepare the working notes? It's really simple. We have already star marked everything. So for every star mark, we'll be opening a ledger account. That's what we do. But now why have I started with PPE account first? That's because see, in the adjustment we have PPE information first, PPE adjustment first. So adjustment wise I'm going right, and then I will see whatever is left. I will open ledger account of that also by seeing the star marks in the question. Is it clear? Okay, so first PPE. In the question here we know there is accumulated depreciation, so we'll be opening 3 accounts: PPE, accumulated depreciation and then asset disposal. So for PPE, opening balance is 32 lakhs, closing balance is 38 lakhs. So see here, PPE account has debit balance, opening balance on debit side 32 lakhs, closing balance on credit side 38 lakhs. Yes. Then see the first adjustment. In first adjustment, what is happening? The company sold one PPE for 1 lakh. That's the sale value which will come in asset disposal account, not in PPE account. Cost of which was 2 lakh. Now the cost will come over here, right? Then they are talking about depreciation. Depreciation provided on it was 80,000. That will go in accumulated depreciation account. Yeah. In PPE account, what we're going to do? PPE account will stay at original cost only whenever we have accumulated depreciation. So only 2 lakh original cost of the asset that we have sold, we will delete that. Is it clear? See here, PPE account will be decreased by 2 lakh because that's the original cost of the asset you have sold. So you will just delete that by asset disposal. Is it clear? Then it will be cross posted in the asset disposal account. We'll see that later. Then what will happen in the PPE account only? Nothing regarding the first adjustment. Come to the second adjustment. The company also decided to write off another item of PPE costing 56,000. So what is happening? We are disposing of another asset and the cost of that is 56,000. Disposing of, writing off is also same like sale only. It's just that we are not getting any money. Is that clear? Yes. So the original cost is how much? 56,000. Doesn't matter whether we have sold it or disposed it. What we have to do in PPE, we have to just delete the original cost. So just delete the original cost. PPE will be decreased by 56,000 because that's the original cost of the asset that we have disposed of. By asset disposal, in bracket you can write written off. Is it clear? Simple. Then see, they are saying on which depreciation amounting to 40,000 has been provided. Now this depreciation will come in accumulated depreciation. There we will delete that. Don't worry. We'll see that. Then they are saying, see, a depreciation on property, plant and equipment provided 3,60,000. See, this is the current year depreciation they have given over there. All right. So that's it. Now let's just balance the PPE account. Everything about PPE is done. Yeah. So see here, credit side is bigger. 2 lakh plus 56,000 plus 38 lakhs. That's equal to 40 lakh 56,000. Right? Take it on both the side and then 40 lakh 56,000 minus 32 lakh. We get a balancing figure of how much? 8 lakh 56,000. Right? So what is this balancing figure on the debit side? It means this much amount has been increased in PPE account. Why it has increased? It has increased because we have purchased. That's our assumption, a valid assumption, right? Whenever there is a balancing figure over here on the debit side, we say it's a purchase of PPE. So to bank 8,56,000, it is affecting the cash. Okay, so it will be subtracted in the investing activity. Is it clear? Simple and straightforward. After this, we open accumulated depreciation account or provision for depreciation account, isn't it? Which has credit balance. So opening balance on the credit side, closing balance on the debit side. So see here, depreciation, accumulated depreciation, opening balance is 9,20,000, closing balance is 11,60,000. 9,20,000. Closing balance is 11,60,000. Now what do we do in accumulated depreciation account? Why do we open this? We open this to calculate current year depreciation. But in this question, current year depreciation is already given over here. See here, already given 3,60,000. So we can take that over here. Actually, the main objective is to find out this thing only, but it's given. So actually we don't have to prepare this only, but still we are preparing to get the whole clarity. Okay. Right. So what is this? Asset disposal, asset disposal. It's really simple. Understand, one asset we have sold and one asset we have disposed of, right? So regarding that, we have to delete accumulated depreciation. We have to delete accumulated depreciation, like how you deleted original cost in PPE account. Similarly here, you have to delete the accumulated depreciation also. So for the first asset which we sold, accumulated depreciation was 80,000. So accumulated depreciation account will be decreased by 80,000. Right, by asset disposal, because that's the asset you have sold. Is it clear? Easy. Next, 40,000 was the depreciation, accumulated depreciation regarding the asset which we have written off. Yeah, the disposed of asset. So that also you will delete. Accumulated depreciation account will be decreased by 40,000 because that's the asset you have written off by asset disposal. Is it clear? Simple and straightforward. Okay, then you just balance this account. You will find this as a balancing figure. That's what actually happens. But here it's directly given. Okay, So what will happen of this depreciation, current year depreciation? You all know we reverse that in the operating activity because it's a non-cash item. Is it clear? Okay. After that, we open asset disposal account. Now, asset disposal, what happens over here in asset disposal? First, we take all the cross postings, right? See, from here 2 lakh and 56 will come. See, 2 PPE, 2 PPE, 2 lakh and 56, right? And then from accumulated depreciation, from here 80,000 and 40,000 will come over here. 80,000, 40,000. You understand? Original cost have come over here, and then whatever depreciation is there till date, it has come over here. Is it clear? This is what happens in asset disposal. Then you see at what amount we have sold it, right? So the first asset we have sold it for how much? 1 lakh, the sale value. Now the sale value will come in the asset disposal because here we sell the asset or we dispose of the asset. So if you are selling the asset, what will happen? For asset disposal, the rule is same like asset account only. If you are selling the asset, it is decreasing. Okay. So by bank 1 lakh. For 1 lakh we have sold it off, right? Now tell me, what is the profit? What is the profit? It's really simple now. The original cost was 2 lakh. Depreciation till date was 80,000, isn't it? See here, 2 lakh was the original cost of the asset which you have sold, and then depreciation you have charged of how much? 80,000 on that. So what's the WDV? WDV is 1,20,000. For how much you have sold? You have sold it for 1 lakh. But the WDV, the book value is 1,20,000. So you have made a loss of how much? 20,000, right? So regarding that, loss will come over here. Okay, by loss on sale 20,000. Is it clear? By profit and loss. Simple, right? So the sale of the PPE, that will be added in investing activity because that's an inflow. But the loss on sale 20,000, this will be, reversed in the operating activity under indirect method, isn't it? Yes, because it's a non-operating item. Is it clear? All right. And then regarding the second asset which we have disposed of, what happened over there? We didn't get any money. The cost was how much? The cost was 56,000 original cost. Yeah, the original cost was 56,000. Depreciation charge till the date of disposal is how much? 40,000. So minus 40,000, right? So that is equal to 16,000 book value. 16,000 was the written down value, but we have not sold it. We haven't got anything for it. Zero. So entire 16,000 is our loss. Is it clear? So see here, by profit and loss, 16,000 loss on asset written off. Can you see that? Let me just show you properly. See here, by profit and loss, 16,000 loss on asset written off. This also you will add in the operating activity. It's a non-operating item. Yeah, you will just reverse it. Is it clear? Simple and straightforward. Then you will just tally this account. It will directly get tally without any balance and all. Is it clear? You understood these 3 working notes? Simple and straightforward. Yeah, so we are done with first 3 adjustment. Next we have regarding investments. See here, company sold investment at a profit of 40,000. Now let's just keep this aside, PP and accumulated depreciation and asset disposal. Let's talk about investment. See here, investment opening balance is 4 lakh, closing balance is 3 lakh 20. Investment which has debit balance, opening balance on the debit side 4 lakh, closing balance on the credit side 3 lakh 20. Okay, the question has said we have sold the investment at a profit of 40,000. At a profit of 40,000 they are saying. So what does that mean? How we are going to take the sale value and all? It's really simple. See, you will just take the profit on the debit to profit and loss. 40,000 profit you have made. You know, right? Loss always comes on the credit side. Profit always comes on the debit side. That's what happens. Okay. So you will take the profit on the debit side, that's 40,000. So 4 lakh plus 40,000, that's equal to 4 lakh 40. 4 lakh 40 over here also, and then you will just subtract with the closing balance. You will find the, the sale value as a balancing figure. Is it clear? This is what you will do, 1,20,000. So now what will happen in the cash flow statement regarding this? Profit and sale will be subtracted. We will reverse it because it's a non-operating item, right? And then the sale will be added in the investing activity, isn't it? Yes, simple and straightforward. After this, what do we have? After this, see, after investments, they are saying debentures and preference share capital redeemed at 5% premium. Debentures were redeemed at the year end. See, it's really simple. First, let's just talk about debentures. Yeah, debentures we have, see here 9% debentures. Interest hidden adjustment is there, we'll do that. But first let's just prepare the ledger account of debentures. See here, 9% debentures account. Opening balance is how much? Opening balance is 4 lakh, closing balance is 2 lakh 80. 4 lakh and 2 lakh 80. Yes. So decrease of how much? Decrease of 1 lakh 20. That's the balancing figure. That's the redemption that has happened. But you have to understand, debentures account, equity share capital account, preference share capital account, these accounts always exist at face value. These accounts always exist at face value. They don't show you the premium thing. Yeah, debentures have been redeemed at premium. Question has said that. See here, debentures and preferential capital have been redeemed at 5% premium. Both are redeemed at 5% premium. So that is why separately we have to take the premium. Is it clear? So 1 lakh 20 you understood. This is just the face value. Redemption will happen at redemption value, face value plus the premium. So this 1,20,000 definitely we have to deduct, but not just this, we have to also take 5% premium. Okay, 1,20,000 into 1.05 you have to do. You will get, 1,26,000, which is the redemption value. This much you have to subtract in the financing activity. Is it clear? 1,20,000 into 1.05, because 5% premium is there. So that is equal to 1,26,000, like this. Okay, simple and straightforward. Now regarding the interest adjustment, hidden adjustment is there. So it's really simple. On which value you will calculate the interest? Will you calculate the interest on 4 lakh or whether on 2 lakh 80? It's really simple. The question has said, see here, debentures have been redeemed at the year end. If debentures have been redeemed at the year end, that means for the entire period, 4 lakh was existing. So on entire 4 lakh interest has been generated. So on opening balance only you will calculate the interest. Is it clear? For the entire year 4 lakh worth of debentures were there. So interest was generated on that. Okay. So on everything you have to calculate the interest. Is it clear? So 4 lakh into 9%, that is equal to 36,000. Okay. What will happen of this 36,000? In operating activities you will add this as non-operating item, right? And you will subtract it in the financing activity because it's a interest that you have paid to the debenture holders, right? So you have to subtract that. Is it clear? See, a question has mentioned debentures were redeemed at the year end, so we will calculate the interest on the opening balance. Fine, simple and straightforward. After this, what we're going to do? After this, we have to do preference share capital, right? The preference share capital, also the same logic and everything is same only. See what they are saying. Preference shares are also redeemed at 5% premium. Okay, so let's open preference share capital account. See, opening balance is 4 lakh, closing balance is how much? 2,80,000. So see here, 4 lakh opening balance, closing balance is 2,80,000, right? 4 lakh on both the sides, 4 lakh minus 2,80,000, that's equal to 1,20,000. That's the redemption. Yeah. Now again, this is also at the face value only. So what we have to do? We have to also take 5% premium. It's really simple. 1,20,000 into 105, that's equal to 1,26,000. Coincidentally, it's coming like this. Coincidentally, in this question, the face value is same. The redemption of face value is same only. 1,20,000 over here also, in debentures also is 1,20,000. That's why everything is coming same. But actually, it will not happen like this in exam. It will be different. Is that clear? So 1,26,000 is the total redemption value. So this much we have to subtract in the financing activity. Okay, preference shares redeemed. Is it clear? Okay, so regarding preference share capital, it's over. After this, what do we have? After this, we have inventory. But before talking about the inventory, let's just see what all ledger accounts are still remaining that we have to prepare. See the star marks. We are done with preference share capital. We are done with, okay, we have general reserve. So let's just do the general reserve. General reserve is really simple now. 6 lakh opening balance, closing balance is 7,60,000. General reserve has credit balance. Opening balance on the credit side, closing balance on the debit side. 6 lakh and 7,60,000. What's the difference? The difference is 1,60,000. Yeah, that's the transfer that has happened. Yeah, which we have made out of profit and loss appropriation account, right? So what we are going to do? We are going to add it back to reverse this appropriation under indirect method. If we are starting from retained earnings, you all know this. Simple, easy. So general reserve you understood, and then what else we have? We have see dividend payable in other current liabilities, right? 1,20,000 opening balance. I told you whenever just opening balance is given, that means that's the dividend paid in the current year. That's all, right? So see here, It's really simple. Dividend payable, opening balance they have given 1,20,000, right? And then the closing balance is 0. So what do we do when like this is given? It's really simple. We assume this 1,20,000 is nothing but dividend paid in the current year. It will be taken directly over here. Okay, it will be subtracted in the financing activity, and then declared in current year is nothing, 0. Is it clear? If let's just say, for example, just opening and closing balance is given and nothing has been said in adjustment, then it's really simple. Opening balance we assume it is paid, closing balance we assume it is provided for the year. Okay, declared in the current year. That's what we do, right? So this is how dividend payable adjustment is. Fine, understood. After this, what else is left? See, current liabilities. Okay, nothing regarding that. Everything is over. No, we have tax also. See here, short term provision. Yeah, provision for tax is really simple. See here, provision for tax has credit balance, so opening balance on the credit side and closing balance on the debit side. Now the question has said, right, opening balance is how much? 3,60,000, closing balance is 3,40,000. Just opening and closing balance is there, nothing else has been said. So if nothing else has been said, what do? We make the assumption. It's really simple. Opening balance has been paid and closing balance is the current year provision. That's what we do. See, 3,60,000 over here, 3,60,000 has been paid. That's the assumption we make. 3,40,000 is the closing balance, 3,40,000 is the current year provision. Same like dividend only. Is it clear? So 3,60,000 will be subtracted in the operating activity at last, and then this 3,40,000 current year provision, what do we do of this? If we are starting from net profit after tax or retained earnings, we just add it, we just reverse the provision. Yeah, current year provision for tax, isn't it? Yes, simple and straightforward, right? So we are done with, all the ledger accounts, isn't it? All the star marks have been covered. Okay, now only the adjustment that is left is regarding the inventory, the most special one. So let's understand what is happening regarding this inventory. See, it's really simple. The question is saying, see here, let's just read this. Company decided to value inventory at cost. Okay, so this is what we have decided in the current year, that we are going to value our inventory at cost. But they are saying, whereas previously, that means previous year, the practice was to value the inventory at cost less 10%. Now understand, they're talking about previous year. So previous year closing stock they are talking about. Previous year closing stock, which becomes opening stock of the current year, isn't it? Yes. So see here, the inventory according to books on 31st March 2020 was 2,16,000. Yeah. Whether they have given inventory over here? No. They have grouped everything all together under other current assets. So we can't see anywhere inventory over here. But they are saying specifically that inventory was 2,16,000 on this date, 31st March 2020. This is the opening inventory, isn't it? This is the opening balance of the inventory. The inventory on 31st March 2021, the closing stock, was correctly valued at 3 lakh. So see what they are saying, there is opening inventory of 2,16,000 and there is closing inventory of 3 lakh. So they are saying this is right, this is wrong. Yeah, that is what they are saying. They are saying this inventory is valued at cost less 10%. From where this inventory came? This inventory came from previous year. In previous year, this was what this opening inventory was, closing inventory, isn't it? So this was valued at 10% less. So now what we have to do in the current year? In the current year, we have to bring this to the cost, okay, to 100%. In previous year, it was valued at minus 10%, which means it is at 90%, right? So now we have to bring it to 100%. If we are bringing it to 100%, that's fine. We'll easily do that. Yeah. See, it's really simple. 2,16,000 divided by what? Divide by 90 we will do, isn't it? Because it is at 90, no? So into 90 we'll do, and we will multiply by 100. We will get what? See here, 2,16,000 divide by 90 into 100, we will get 2,40,000. So 2,40,000 will be the correct value of the inventory, opening inventory. We have brought it to 100% cost. That's what they said, na? Company decided to value inventory at cost. But this inventory came from previous year, isn't it? So that is why we had to make that change. So we made the change and we made this also correct. Now if we are changing this, then what will happen is the profit will also be impacted. Do you understand? Do you remember the accounting equation? Asset is equal to liabilities plus capital, right? Or equity. So liabilities haven't changed, it's same only, but asset value you have changed. You have decided to revalue the inventory. Yeah, you have increased the value of inventory, you have increased the asset value. If you're increasing the asset value, liability is same only, then of course equity will also increase now, then only accounting equation will hold. So if equity also has to increase, how it will increase? Whether capital will increase? No, understand, profit will increase, isn't it? You remember how it happens? See, let me just show you. It's really simple. Inventory adjustment. You understood the logic and everything. See here. Inventory adjustment. Opening balance 2,16,000. Yeah. Opening inventory, opening stock, closing stock 3 lakh. Just now we discussed the same thing. This is at cost less 10%. As I said, it is at 90%. So we have to make it at cost. We have to bring it to cost 100%, isn't it? So now how that will happen? First we have to calculate that 10%. Yeah. We can calculate that 10% directly, make it 100% also. So let's calculate 2,16,000 divided by 90 into 10. If we do, we get to know what's that 10%. Yeah, it is cost less 10%, right? So what's that 10% decrease? That is 24,000. It is valued less by 24,000. So we will increase. See here, rectify opening balance of inventory 2,16,000 plus 24,000, that's equal to 2,40,000. Consider this in working capital changes, isn't it? We take the inventory in working capital changes, so we are going to take that. Is it clear? What we're going to take? We're going to take 2,40,000 and compare with the closing balance 2,40,000 to 3 lakh. But understand, in this question what has happened? In this question they have not given us the separate current assets figure. They have given us current assets all together, right? Everything has been grouped together. So that is why what we're going to do is we are going to take the current asset opening balance, that is 1,10,000, and we're going to add 24,000 to that. It will become 11,34,000. Then we will compare 11,34,000 with the closing balance of current asset 11,50,000. Is it clear? This is what we are going to do. Okay, you understood? Here also in rough I explained you the same thing only, but here directly I did this 2,16,000 divided by 90 into 100. Directly I found out 2,40,000, this thing. Okay, is it clear? But here in this question what has happened? In this question current assets have been grouped together, so I'm finding out like this also. Yeah, 10% decrease is there, so that decrease I found out, that is 24,000, and I increased it. Is it clear? Simple. Now as I told you, if we are increasing the asset, then we also have to increase the profit. Okay, so which profit we are going to increase? We have two profits over here, isn't it? We have two profits over here. See, profit and loss account, two balances are there, opening balance and closing balance. Now understand which stock got affected, which stock? This stock got affected. Yeah, opening stock got affected. From where did we get this opening stock? This opening stock came from the previous year's closing stock. Previous year closing stock became opening stock of the current year. So we will change the profit of previous year only. Okay, opening balance of profit we are going to change. Is it clear? See, it's really simple. 24,000 we have increased in asset, we have to increase 24,000 in profit. Accounting equation, remember that. In profit we have two profits, opening balance and closing balance. So which profit we will change? Opening profit. Is it clear? 2,40,000 plus 24,000, that is equal to 2,64,000. Is it clear? From where did I get this 2,40,000 and 3,40,000? Here, profit and loss 2,40,000, 3,40,000. Is it clear? Okay, so that is what you have to do, and this 2,64,000 you will consider. Now in indirect method, when you will be taking the difference in profit, yeah, retained profit, how you are going to take that? Closing minus opening, right? So that is what you are going to do, 3,40,000 minus 2,64,000. Is it clear? Simple and straightforward. This is what you have to do. Okay, now the logic is really simple. I explained you, right, why we are changing the profit accounting equation. Yeah, or you can see the trading account also. You remember, if closing stock used to increase, what used to happen? Profit also used to increase, isn't it? That's the logic. You increase the closing stock. Yeah, in the previous year now, this opening stock came from the previous year. So in previous year you increase the closing stock, that means previous year profit will also increase now. Is it clear? That's the logic. Fine. So you understood this inventory adjustment. you just have to do two things. First, you have to rectify the inventory balance, because that rectified one will be considered in working capital changes, and then also you have to change the profit also. Is it clear? Simple and straightforward. Now let's just see the solution and let's see how to prepare the cash flow statement now. Now see, here we have the solution. It's really simple. The cash flow statement of New Light Limited for the year ending 31st March 2021, and we are doing this as per the indirect method. So first, let's start from cash flow from operating activities. Now you all know in indirect method we start from profit. Yeah, first priority we give to net profit before tax, then net profit after tax, and if that is also not available, then we have no choice but to start from retained profit, retained earnings. How will we get retained earnings? In this question, you all know there was inventory adjustment. Because of inventory adjustment, what happened? Our opening balance of profit got changed. We increased the profit. Yes, we increased the inventory, so we had to increase the profit also. So opening balance is how much? 2,64,000. So closing minus this opening we are going to do 3,40,000 minus 2,64,000. 3,40,000 minus 2,64,000, that is equal to 76,000. 76,000 will be our profit. Okay, retained profit. See here, closing balance of profit and loss minus opening balance of profit and loss account after inventory adjustment. You have to write that because you have done a change over there, isn't it? So you have to notify the examiner that you have done it. 340 minus 2,64,000, that is equal to 76,000. Is it clear? Simple. Then what you will do, you all know as per the format, what we do is we reverse all the appropriation. Where you are right now, you have found out this profit after all adjustment, then you have to reverse all appropriations, isn't it? So what appropriation? Is there any dividend that has been, what do you say, declared? No, there has been no dividend declared in the current year, but we have made a transfer to general reserve, isn't it? In general reserve, from 6 lakh it has become 7,60,000. 1,60,000 transfer has happened. We saw the ledger account also. See, general reserve 1,60,000. We have to add this in the operating activity only if you start from retained earnings. Yeah, reversal of appropriation. So let's do that. Reverse appropriation, transfer to general reserve 1,60,000. We will add it. Why we are going to add it? Because understand, previously it has been deducted, transfer to reserves as an appropriation. Now you are going to add and reverse it. Fine. So when you do that, 76 plus 1,60,000, that is equal to 2,36,000, which is nothing but net profit after tax. Clear? Easy. Then what you have to do, from net profit after tax, you have to reach to where? You have to reach to net profit before tax and before extraordinary items. So simply you have to reverse tax provision, right? And how much is the provision for tax in the current year? That is 3,40,000. Yes, in the ledger account we found that out. So reverse the tax provision, add it. 3,40,000, if you add, you get 5,76,000, which is nothing but net profit before tax and extraordinary items. Is it clear? Simple. Now your actual solution starts. You can also do this in the working note if you want, right? So what's the first thing that you do to net profit before tax? First, you reverse non-cash and non-operating items, right? How will you find that out? See, understand, whenever you think about non-cash, always remember depreciation. Depreciation is the simple example of non-cash, right? Do we have depreciation in this question? Of course we do, right? In the adjustment only they directly told us that depreciation on PP is how much? It is 3,60,000. Yes. So we can't take it directly from there. We always see our ledger account because we have done so much calculation, isn't it? See here, current year depreciation is there, 3,60,000. So depreciation will add and reverse it because it's an expense that has been, debited to P&L. So we are adding it to reverse it. Is it clear? After this, what else do we have? Check the ledger accounts only, right? Do we have anything non-cash or non-operating over here? In PP, no. In accumulated depreciation, we took that. In asset disposal, yes. Understand. Here we have loss on sale and here also we have loss on asset written off. What are these? Both of these are non-operating expenses that are sitting in the P&L. They have been debited in P&L. They have been subtracted in P&L. Now what you will do? To reverse, you will add both of these guys. Operating plus, operating plus. Is it clear? So see here, loss on sale of PP, loss on sale of PP written off, 20,000, 16,000. Yeah, you will add and reverse them. Fine. Okay. Then do we have anything else in asset disposal? No, just these two. regarding non-operating. Yeah, then let's check in investments account. Yeah, you have to go sequentially in the working notes and find out are there any non-cash or non-operating. Okay, in investment account, yes, we have profit on sale. Profit on sale is what? Non-operating income which is credited to P&L, which has been added to P&L. Now to reverse, what you will do, you will subtract in operating activity 40,000. Yeah, see here, profit on sale of investment, yeah, minus 40,000. Is that clear? Simple and straightforward. Then what happened? Then move on to the debentures. Is there anything in debentures account? Yes, understand. In debentures account, we have what? In debentures, we have interest on debenture. Hidden adjustment was there. They gave us the rate. We calculated, and I told you we have to reverse it in the operating, isn't it? Because interest on debenture is an expense which is debited to P&L. So that expense we have to reverse because it relates to financing activity. It's non-operating expense. It has been subtracted, it has been debited. Now to reverse, we have to add it back. Okay, so see here, interest on debentures 36,000. Clear? Okay. And then regarding premium on redemption of debentures, why are we taking this over here? Understand, I told you in the first video of this chapter only that premium on redemption of debenture or preference shares written off, it can be an appropriation item as well as charge to profit and loss. Charge to profit and loss means what? It has been debited inside the P&L account, right? If that happens, then we always have to reverse it over here. Okay, in non-cash, non-operating, always we have to reverse it. And this is what we always assume because ICAI does that. Okay, is that clear? In silent question, always assume it is charged to P&L and always add it over here and reverse it. So premium or redemption of debenture is there in this question, isn't it? Yeah, there is premium, right? How much premium is there? 5% premium, 5% on this 1,20,000. That was how much? 6,000. Yeah, 1,26,000, no? So 6,000 premium. So that 6,000 you have to add and reverse. It was an expense, no? It was debited, it was subtracted earlier. Now you are adding and reversing it. Fine, understood. Then what? Then see the ledger accounts. After this, what do we have? We have preference share capital. In preference share capital also same thing, you know, we have made the redemption. It happened at premium. So that 5% extra thing which we paid here also it's 6,000 only coincidentally. So that 6,000 premium, it has been debited to P&L. We are making the assumption of that. It can also be appropriation item, but we are making the assumption it has been charged to P&L and we are reversing it over here. Premium on redemption of preference shares. The same logic. 6,000 we are going to add. Is it clear? Simple and straightforward. And then after this, do we have anything else? No, dividend paid will not come. No, nothing else, right? That's all. Yeah, that's all. All the working notes are over. Nothing else. In the question also there is nothing. Yeah, you can see the adjustment and all. Nothing. We have covered everything. Yeah, so all non-cash, non-operating are done. So you will just make a sum of this. 5,76,000 plus 360 plus 20 plus 16 minus 40 plus 6 plus 36 plus 6. That is equal to 9,80,000, which is nothing but we call operating profit before working capital changes. Then you do working capital changes, right? So to do working capital changes, what you have to do, you have to go to the question, you have to find current asset and current liabilities. Yeah, we have current liabilities over here. See what is happening to current liabilities. It is increasing from 4,80,000 to 5,20,000, 40,000 increase. If current liabilities increases, that means, you know, cash also positive impact, it's increasing. We will add it in the working capital changes. So see, increase in current liabilities 40,000 plus. Is it clear? Simple. Then after this, we have to see current assets. What's happening to current assets? Now, can we see current asset directly in the question over here? Can we take this current asset 11,10,000 and 11,50,000? Can we compare this? No, we can't. Why not? Because we had an inventory adjustment. In inventory adjustment, we changed the inventory balance now. This 2,16,000 opening balance of inventory used to exist in this 11,10,000. So we made a change to that. Yeah, we have increased it by 24,000. So our updated total current asset balance is how much? Opening balance 11,34,000. So 11,34,000 and this you will compare. Okay, 11,50,000 closing balance of current assets. So see here, 11,50,000 minus 11,34,000 closing minus opening, if we do, we can find out 16,000 increase has happened in the other current assets. Yeah, inventory is also included in that. You see, in working capital changes, what are we doing? We are considering the updated balance of inventory. You have to understand that two effect is happening. One effect is in profit. Yeah, we change the profit, retained profit change. Then at the below, we are also considering in working capital changes the updated balance. So actually the effect are nullified. Okay, even if you ignore the inventory adjustment in the question, still your answer will be same only. Why? Because you're changing the profit as well as you are making the change over here. So it gets nullified actually. One effect is in the asset and another effect is in the profit. Both gets nullified. But still ICAI does the inventory adjustment. We have to do the inventory adjustment. Okay. So what we were saying, 16,000 increase has happened in other current assets. So let's just take that. See here, increase in other current assets. 16,000 increases happen. If current asset increases, that means what happens to cash? Negatively related. Cash decreases, right? So see here, minus 16,000. You all know that, right? That's our trick, no? Changes in working capital, current assets are negatively related with cash. If current assets are increasing, cash is getting negatively impacted. Okay, fine, understood. So when we do this, 9,80,000 plus 40 minus 16, that is equal to cash generated from operations 10,04,000. Is it clear? Simple and straightforward. Now after this, what do? We subtract the tax paid, right? How much is the tax paid? Tax paid is, if we see the ledger account, working note, 3,60,000. Yeah, we subtracted in operating activity. So let's subtract tax paid minus 360, that would be equal to 6,44,000. Is it clear? Net cash generated from operating activities. Because of the operations of the business, this much cash has been generated. Clear? Easy, simple. After this, we start investing activities, cash flows from investing activities. Now, how are we going to take in investing activities? Really simple. You have the working notes, right? Start from the working notes. First, PP, right? Investing activities is mostly related with PP only. So in PP account, what has happened? The first working note, we have made a purchase of PP of how much? 8,56,000. When we purchase, we pay the money, so we have to subtract it in investing activity. So see here, purchase of PP minus 8,56,000. Clear? Okay. Then in the second working note, are we going to take anything from accumulated depreciation? No. In asset disposal, yes, in asset disposal we sell the PP, right? So for how much we have sold? Yes, we have sold over here for 1 lakh. So if you are selling, we are getting the money, we have to add it in investing activity. So see here, sale of PP, right? 1 lakh. Clear? Then in the next working note, we had investments. Investment is also related with what? It's an asset, no? It's related with investing activity only. So here also, have we purchased anything? No, we have not purchased, but we have sold for 1,20,000. So if you are selling, we are getting the money, we have to add it in investing activity, right? So see here, sale of investment plus 1,20,000. Then we don't have anything else. Debentures, financing activity, nothing will be there. Then if you see here also preferential financing activity, this is the financing activity, dividend payable, yeah, all financing activity thing only, right? This is operation. Yes, general reserve is just appropriation. So nothing regarding investing activity. Then what you have to do, you have to look into the question, but we haven't missed anything, right? In the question also, yes, everything has been covered, isn't it? Yes, we have star mark everything, we have made working notes, so nothing has been missed in the question also. So that's all in the investing activity. So we'll just make a sum. See here, minus 8,56,000 plus 1 lakh plus 1,20,000, that is equal to 6,36,000 negative. It's coming negative, right? So that means this much cash we have lost because of investing activities, right? Net cash used, you have to write in investing activities. All right. After this, we move on to the financing activities. Now, how are we going to take in financing activities? The same way. First, start from the working notes. Right, first we had PPE and then accumulated depreciation, asset disposal. Nothing will be there from over here because these are related with investment, right? So nothing. And then here we had investment, this is also nothing. Then we have debentures. Of course, debentures is related with financing. So what has happened? We have made a redemption. So can we take 1,20,000 in financing activity? No, you all know we have to take the whole value, redemption value. 1,26,000. We have to consider the premium also. So see here, redemption of debentures 1,26,000 we have to subtract. And then after redemption of debentures we also had what? Interest adjustment, isn't it? So we reverse that in the operating, but we have to subtract that in financing also because we have actually made the interest payment. Yes, so we are going to subtract the interest paid on debentures minus 36,000. Is it clear? Simple and straightforward. Then we had redemption of preference shares also. That is also related with financing. Yes, we can't take 1,20,000. We have to take 1,26,000. So redemption of preference shares 1,26,000. We are going to subtract because we are making the payment. Clear? Then what else do we have? Then in the question, if you see in the beginning, we haven't made a ledger account for that. So you have to be careful, okay? Whatever you are done with, no, you have to go on ticking. So one thing is still there, that's equity share capital. Yeah, we haven't opened working note or anything regarding this. Yeah, from 12 lakh, it has become 16 lakh, 4 lakh increase. I told you, no adjustment, nothing. That means we have definitely made an issue. It's a valid assumption, right? So 4 lakh issue of equity shares has happened. So proceeds from issue of equity shares, that's 4 lakh. Is it clear? Simple and straightforward. Yeah. Is everything done? No. See here, we have dividend paid also. How much dividend we have paid? 1,20,000. Yes. So that also we have to deduct in financing activity, dividend paid minus 1,20,000. Then everything is done. Yeah, everything is done. So make a sum in financing activity. 4 lakh minus 126 minus 126 minus 36 minus 120. If you make a sum, you get answer 8,000. Okay. Can you see that? So this will be net cash used in financing activities, because the financing activities, this much cash we have lost. All right. Now what do we do? When we have all the three cash flows, net cash flows, we just make a sum. 6,44,000 plus 6,36,000. Sorry, it's minus, no? Minus 6,36,000 minus 8,000. That is equal to 0. Can you see? That is equal to 0. So that's our answer and it's correct. I told you in the beginning only that cash and cash equivalent, there has been no movement. 10,000 in the beginning opening balance and the closing balance was 10,000. So our answer has to be 0. Then only it will be same. Opening balance will be equal to closing balance. See here, this is net cash and cash equivalent 0. So 0 plus opening balance 10,000 of cash and cash equivalent, 0 plus 10, that will be equal to 10,000 closing balance, cash and cash equivalent at the end of the period. Is it clear? Simple and straightforward. Yeah, this was the whole solution. Yeah, we have discussed each and everything in detail, isn't it? The only new thing that you understood over here is what? The inventory adjustment. And it was really simple. It was not difficult. It just seems difficult. You just have to do just two things. First, rectify the balance of inventory, whatever they have said, right? So that updated balance you can take in working capital changes, and then you have to update the profit also. You have to see how profit is getting affected by this inventory change and take it, right? Here opening stock of inventory change, opening profit change, like that, right? Easy, isn't it? Yes. So that was all for this video. If you have any doubts and all, please comment down below or just message me in Instagram. All the notes and everything will be uploaded on our Telegram channel, Saheb Academy 7. Okay, that's all. Yeah, see you in the next video. Bye.